Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamilton, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're focusing on the recent drop in fixed mortgage rates, which could be a significant boost for potential homebuyers. According to Robert McLister, a mortgage strategist and interest rate analyst, the ongoing tariff disputes initiated by former United States President Donald Trump have led to a cloud of uncertainty over Canada's economic future. This uncertainty has prompted many investors to flock to bonds, which in turn has driven down bond yields and subsequently fixed mortgage rates. In fact, the tariff-induced turmoil has led to fixed mortgage rates dropping by a quarter percentage point below some floating rates. The money markets are now suggesting a 2/3 probability that variable rates might see another quarter point decrease after the Bank of Canada's upcoming meeting on March 12th. Over the past week, we've observed that the lowest nationally advertised fixed rates have decreased for 7 out of the 12 terms tracked. Notably, the insured 5-year fixed rate has plummeted by 29 basis points to 3.85%, a rate we haven't seen since April 2022, courtesy of Citadel Mortgage. This drop in rates is both a psychological stimulant for the real estate market and a boost to buying power for potential homebuyers. These changes are likely to encourage more potential homebuyers to shift from mere window shopping to actually purchasing homes. The combination of lower rates and increased buying power could lead to a more active real estate market as buyers feel more confident in their financial ability to purchase property. Turning our attention to the recent market fluctuations, 5-year fixed mortgage rates have dipped below 4%, hitting 2.5-year lows. This development comes on the heels of a temporary reprieve from a trade war between Canada and the United States, which was narrowly avoided this week. While this provides a momentary sigh of relief, the broader uncertainty remains, and it's crucial for those shopping for a new mortgage rate or facing renewal to stay informed. The drop in rates is closely linked to the movement in bond yields. On Monday, stock markets saw a significant tumble as investors reacted to United States President Donald Trump's executive order that hinted at an impending trade war. In response, investors sought refuge in safe haven investments, causing bond prices to rise and yields to fall to levels not seen since early 2022. Specifically, the Government of Canada 5-year bond yield started the week around 2.5%, putting downward pressure on fixed mortgage rates. By Tuesday, lenders had adjusted to these changes, with the lowest 5-year fixed term in Canada dropping to 3.89%. This marks the lowest point for this rate since the summer of 2022, and is only the second time since then that borrowers have seen a 5-year fixed rate starting with a 3. However, the question remains, how long will these low rates persist? While Monday's market slump was short-lived and both stock and bond prices began to stabilize with news of a 30-day tariff delay for Mexico and Canada, the 5-year yield has since recovered to the 2.6% range. Nonetheless, investors continue to price in a significant amount of uncertainty, which is likely to keep yields relatively low in the near term. As it stands, the 5-year yield remains 10 to 15 basis points below its position just last week and about 60 basis points below its mid-January peak of 3.28%. For those considering a new mortgage rate, the advice is clear. Do not delay in securing a pre-approval and rate hold. This strategy ensures access to the lowest rates available today for up to 120 days, safeguarding against potential increases in bond yields and rates in the short term. There's also the matter of variable rates, which are expected to decrease, albeit the exact amount remains uncertain. The tariffs could influence the Bank of Canada to cut its benchmark rate more aggressively than anticipated. Canada's 2-year bond yield, which is particularly sensitive to central bank actions, also fell by 20 basis points to a 3-year low earlier this week, though it has slightly increased since. Douglas Porter, chief economist at Bank of Montreal, suggests that if the United States implements 25% tariffs across the board, the Bank of Canada might reduce its policy rate by a quarter point in each of its upcoming meetings until October. This scenario could see variable mortgage rates drop to the 2.7% range. Without tariffs, however, the rate cuts might be fewer, leaving variable rate offerings closer to the 3.7% range. Interest in variable rates has surged among borrowers, with inquiries about variable rates now comprising about half of all client requests at brokerages, a noticeable increase from December. This trend is fueled by the promise of lower rates, despite the inherent risks associated with economic uncertainties. Borrowers opting for variable rates should weigh their risk tolerance, as potential tariff-induced stagflation could lead to future rate hikes by the central bank. Let's delve into the recent trends in the rental market across Ontario. The latest national rent report has revealed a significant decline in rental prices, with the average asking rent for all residential properties in Canada dropping to $2,100 in January. This marks a 4.4% annual decline and is the fourth consecutive month of annual rent decreases, following a period of 38 straight months of rent hikes. Ontario, in particular, has experienced the steepest decline among the provinces. This trend is notably pronounced in Kingston, Eastern Ontario, where rents for all rental types have decreased by 9.5% year over year. This decline is second only to Richmond Hill's 12.2% drop. Specifically, rents for two-bedroom units in Kingston have decreased by 11.8%, marking the largest drop in the nation. Despite the overall decline, Kingston's average rent for one-bedroom rentals stands at $1,811 per month, which is up 1.4% from last month, but still down 3.5% from the previous year. Meanwhile, two-bedroom rentals in Kingston are slightly down from last month to $2,051 a month, yet they have seen a drastic drop from last year. Oshawa presents a more consistent picture, with one-bedroom units down 1.5% month-over-month and 2% year-over-year, now at $1,799 per month. Two-bedroom rentals in Oshawa have remained almost unchanged from last month, priced at $2,168 a month. Ontario as a whole saw apartment rents fall by 5.2% annually, with Toronto experiencing a 7.6% drop year-over-year. Despite this decline, Toronto remains the second most expensive city for rentals in Canada, after Vancouver, with one-bedroom apartments at $2,353 and two-bedroom units at $3,063. The report, compiled by Urbanation, a Toronto-based real estate research firm, highlights that the downward trend for rents in Canada accelerated during the first month of 2025. Urbanation President Sean Hildebrand attributes this to heightened downside risks for the economy, declining international population inflows, and a surge in apartment completions, suggesting that rents may continue to weaken, thereby improving affordability for renters. Much of the decline in rents was observed in the secondary rental market, where asking rents for condominium apartments fell by 6.5% year-over-year to an average of $2,219. Rents for houses and townhomes declined by 8.9% to $2,144. On the other hand, purpose-built rental apartments experienced a milder decrease of 1.7% across the country, with certain unit types like studio and three-bedroom apartments even seeing an increase in rents by 2.1% year-over-year. The Canada Mortgage and Housing Corporation has unveiled its 2025 housing market outlook, providing insights into the factors that are likely to influence Canada's housing sector over the next 3 years. The report highlights the impact of economic uncertainty, shifting immigration policies, and interest rate movements on the housing market. With trade tensions between Canada and the United States escalating, the economic outlook remains uncertain. The CMHC outlines 3 potential scenarios for the economy and housing market, each influenced by varying degrees of trade disruption. Despite these risks, the CMHC anticipates an improvement in housing activity in 2025, largely driven by lower mortgage rates and pent-up demand. One significant risk factor is Canada's trade relationship with the United States. The potential for U.S. tariffs of up to 25% on Canadian exports could lead to weaker economic growth and job losses. If the US imposes a 25% tariff on 10% of Canadian goods, the Canadian government may respond with its own tariffs, further straining economic conditions. However, the CMHC suggests that increased US government spending might bolster demand for imports, potentially softening the economic impact. Changes in immigration policy will also influence the housing market. The federal government's decision to lower immigration targets between 2025 and 2027 is expected to slow population growth, affecting housing demand. While these changes will be implemented gradually, fewer newcomers could lead to weaker rental demand and a slower pace of home sales. Despite these challenges, the CMHC expects modest economic growth in 2025, with improvements in 2026 and 2027 as conditions stabilize. The Bank of Canada is projected to cut interest rates further in 2025 to support economic recovery, which should ease borrowing costs. This is likely to make variable rate mortgages, which are directly tied to the policy rate, more attractive to buyers. The CMHC forecasts that housing activity will improve in 2025 as lower interest rates and changes to mortgage qualification rules unlock demand from home buyers who had previously been priced out. However, affordability challenges remain, with home prices expected to rise, pushing some buyers toward longer mortgage terms and larger down payment requirements. Resale homes are expected to see the most activity as they offer more options for financially constrained buyers compared to newly built homes. New home construction is anticipated to be slower due to high costs and tighter financing conditions. Millennials, who have delayed purchasing due to affordability concerns, will be key drivers of housing demand, particularly in larger urban markets like Ontario and British Columbia. The condominium market, especially in regions where investors have driven pre-construction sales, is expected to lag behind. Rising financing costs and record-high condo completions in 2025 will likely increase resale listings, softening demand in this segment. The CMHC expects housing starts to slow over the next 3 years, primarily due to declining investor interest in pre-construction condos. The rental market is also undergoing changes. Since 2024, rental supply has been growing faster than demand, leading to increased vacancy rates and slower rent growth. This trend is expected to continue through 2025, particularly with lower immigration contributing to weaker rental demand. Although rental affordability is expected to improve gradually, many renters will still face challenges due to elevated market rents. The CMHC's outlook remains highly uncertain, with trade tensions, interest rates, and policy decisions all playing crucial roles in determining the market's trajectory. In a low-growth scenario, higher U.S. tariffs could push Canada into a recession, delaying housing recovery until late 2026. Conversely, a high-growth scenario with fewer tariffs and strong U.S. government spending could boost the economy and accelerate housing demand. Toronto's real estate market continues to face significant challenges as nearly 20,000 homes remain unsold. The Toronto Regional Real Estate Board, TRREB, recently released market figures showing a 7.9% decrease in home sales across the Greater Toronto Area compared to January 2024, despite a 70.2% increase in active listings. This scenario presents a concerning trend for the city, where the market has long been considered overvalued. Interestingly, despite the sales slump, the average price of homes sold last month was 1.5% higher than the same month last year. This suggests that while sellers may be eager, they are not yet desperate enough to significantly lower prices. Condominiums, however, diverged from this pattern, experiencing a 1.6% price drop on average. The decline in condo prices was particularly noticeable in Toronto's downtown core, the 416 area code, where interest in new builds has waned. This lack of interest has led some developers to delay projects or face financial difficulties. TRREB remains hopeful for a market turnaround by spring, citing lower borrowing costs and increased supply as factors that could enhance affordability and draw buyers back. The board forecasts a 12.4% increase in home sales over the year compared to 2024, with prices anticipated to rise by 2.6% to an average of $1,147,000. Recently, A modern Ontario farmhouse located at 908 Vandorf Side Road in Aurora has caught the attention of potential buyers after a significant price reduction. Originally listed for $6,950,000 in 2024, the property has now been relisted for $5,495,000, marking a price drop of nearly $1.5 million. Realtor Carolyn Syme, who is handling the sale, attributes this price adjustment to the current state of the market rather than any shortcomings of the property itself. According to Syme, only 8 homes in Aurora have sold for over $4 million between September 2023 and January 2025, highlighting the challenges in the luxury segment of the real estate market. The farmhouse, a reproduction of an early Ontario design by architect Stephen J. McCasey, combines traditional charm with modern amenities. It features 4 bedrooms, each with its own ensuite bathroom, and 6 bathrooms in total. The main floor boasts a great room with vaulted ceilings, natural wood beam trusses, and a floor-to-ceiling fieldstone gas fireplace, creating a warm and inviting atmosphere. Additional highlights of the property include a classic kitchen with a waterfall marble island, a dining room with a fireplace, and a 3-season Muskoka room. There's also a home office on the main floor and a fully finished basement with a gym and a large recreation room, making it ideal for both work and leisure. The property spans 12 acres, with 6 acres covered in cedar bushes, providing ample outdoor space for relaxation and entertainment. The backyard features a large patio and deck, along with a hot tub, offering a perfect setting for outdoor gatherings. Despite the current market conditions, Syme remains optimistic about the property's prospects, noting that the market is expected to rebound in 2025. With its blend of historic charm and modern luxury, the farmhouse offers a unique opportunity for buyers seeking a distinctive home within a reasonable distance from Toronto. Farm Lending Canada has partnered with the Bank of Montreal to capitalize on the burgeoning agricultural financing sector. This collaboration marks a significant step for Farm Lending Canada, a company that pivoted to the agricultural lending market under a new brand in 2019. Initially, they partnered with EQ Bank and an unnamed major financial institution to provide underwriting support. Now, the addition of the Bank of Montreal, with the potential for a 4th partner soon, underscores the growing interest from major banks in this asset class. Rob Nelson, the Chief Executive Officer of Farm Lending Canada, explained that banks are drawn to the agricultural asset class due to its stability and resilience. They love the asset class, all banks do, and they saw how we operate, Nelson shared in an interview. This new partnership enables Farm Lending Canada to access lower-cost capital, which can be passed on to consumers, thereby expanding their capital base. Nelson emphasized the market size, pointing out that it is in the multi-billions, necessitating access to substantial capital to meet demand. This announcement follows a recent $60 million commitment by Farm Credit Canada to Glengarry Farm Financial Corporation, which aims to support farmers facing temporary financial challenges. The agricultural alternative lending space offers unique opportunities, particularly for brokers with roots in farming communities. Nelson noted that the agricultural asset class is inflation-resistant and non-correlated to the commercial or residential markets, making it an attractive option for brokers. Nelson acknowledged that not all brokers might be suited for agricultural lending, but those with connections to rural communities should consider exploring this niche market. They already know all about the borrowing habits of farmers, but they've never had a product to position for them. This is the first, he stated. The AgriRoots Fund offers short-term bridge financing, typically around 18 months, helping borrowers transition back to mainstream lending. Nelson highlighted the broker community's role in aiding farmers to move from alternative credit back to prime lending within this period. As Nelson reflects on his 25-year career, he recalls a time when agricultural-specific products were scarce, particularly for brokers. The growth of the broker channel has since expanded into rural areas, catering to their specific needs. However, regulatory changes have limited lenders' flexibility in offering tailored products, leaving about 20% of farmers annually seeking alternative financing. Farm Lending Canada aims to fill this gap, providing necessary financial solutions. The agricultural lending sector is poised for growth, driven by generational transitions in farm ownership. Nelson projected that around 20% of farmers will retire in the next 8 years, resulting in approximately $200 billion in assets needing new hands. This transition will require financing options, particularly in an industry currently holding about $190 billion in debt. Nelson estimates a 50 to 70% increase in borrowing capacity will be needed over the next 8 years. Let's turn our attention to the Quinte real estate market, where recent data from the Central Lakes Association of Realtors, or CLAR, shows a slight increase in sales for January 2025 compared to the previous year. CLAR President Vicky Sweeney noted that the number of sales is up in nearly all regions, suggesting a strong start to the year. She also mentioned that with recent tariff announcements, CLAR will be working with various government levels to address any potential impacts on the housing market. In Hastings County, the average home price in January 2025 was $511,637, with 102 properties sold. This is a small increase from 100 sales in January 2024. Active listings, however, have more than doubled from 249 to 514, indicating a significant rise in available inventory. Prince Edward County also saw a rise in sales, from 15 in January 2024 to 21 in January 2025. However, the average price fell from $704,597 to $679,824 over the same period. This suggests a shift in market dynamics, with more transactions occurring at lower price points. Meanwhile, in Northumberland County, the average price decreased from $709,097 to $639,707 in January 2025, with sales dropping slightly from 82 to 79. Active listings saw a notable increase of 27% year over year, which could indicate a cooling market as more properties become available. Over in the Durham region, the average home price in January 2025 was $896,611, a slight increase from $894,825 in January 2024. However, sales decreased from 539 to 489, reflecting a potential slowdown in buyer activity. The Kawartha Lakes area experienced a 7.5% increase in average price, rising to $755,211 from $702,016 in January 2024. The number of sales also rose slightly from 51 to 53, indicating a modest uptick in market activity. In Peterborough, there were 89 sales in January 2025, with an average price of $605,229, marking a 5.3% decrease from $639,268 in January 2024. Despite the price drop, active listings rose significantly, increasing 76% from 195 in January 2024 to 345 in January 2025. The Central Lakes Association of Realtors is keenly focused on housing policy as Ontario nears the provincial election. CLAR CEO Wendy Giroux stated that they will actively participate in candidate events and debates, advocating for housing to be a top priority for all political parties. They support the Ontario Real Estate Association's A Home for Everyone 2025 platform, which emphasizes pro-growth, pro-ownership, and pro-affordability policies aimed at reducing home ownership costs, boosting consumer confidence, and increasing housing supply. This platform will be a focal point of their advocacy efforts in the upcoming month. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder: Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.